are live.
Monday, 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 Money Mondays.
Money Mondays.
We are live here at Disrupt TV Studios, right?
Paris.
Houston, Texas.
Hey, I say that.
That's fine,
Steal
man.
my thunder.
We'll figure out our routine. You know, if it was any other day but Mondays, we would figure it out. But Mondays are not the simplest days. So, how's everyone doing?
Good, man. Good. It was a good weekend, relaxed. We got some work done.
We did get some work done again, so.
It's nice to kind of do a little bit of empire building, like you like to say.
That's my favorite term, man. You kind of learn that from the tech world, I guess. Or maybe I made that up. I don't know.
You got to work on your business, folks, not in your business all the time.
This is true.
You will be in the weeds as an entrepreneur sometimes, but you don't want to be in the weeds all the time.
This is very true. So what's our topic today, Ben?
Talking underwriting, the numbers, the most important thing, because numbers do not lie.
Yeah, and I think we've underwritten a few deals or two.
Couple, yeah.
So for those watching, right, just to kind of recap, the goal is really doing, essentially one different topic every week, right? We're going to start to be better about announcing the topic earlier on, so on Tuesday, and giving people a chance to submit questions beforehand. And basically 3:30 Central on Mondays, we'll do Money Mondays, and we'll do, basically start talking through the topic, do a little bit of a presentation, then Q&A. So the real value is Q&A, so folks, so please go ahead and leave your questions right now. We're happy to answer them here live and go through it, and maybe you have a follow-up question to the question. So definitely let us know. It's on our Facebook page, and we'll go live there every Monday. So definitely feel free to reach out, people. So I'm just gonna be hanging out on this laptop while Ben does all the talking.
No, and one thing to talk about too, right, is we're open to you, our audience, submitting topics as well, right? We don't always want to just assume what everybody wants to hear, right? Come out, and it doesn't have to necessarily be multifamily, right? We're entrepreneurs, we're business people, we're investors and other things too. So, we can talk about a myriad of things. So let's, kind of get into it. What do you think, man?
Let's do it. Let's make it happen, man.
All right.
Let's go through our presentation. So
we're talking underwriting. Why don't you start off? What is underwriting, man?
Underwriting. So basically, you have a lot of writing you do, and you try to get under it. No, I got that wrong. So underwriting, essentially, really simplifying, it's the art of analyzing a deal, right? And we underwrite deals for acquisitions, but lenders underwrite a deal for lending, just like anyone else is underwriting a deal for something else. So it's really I'm curious what the official definition is, but I think it's really just taking an analytical approach to something with some sort of goal. So our goal is acquisitions, right? So how do we start to analyze a deal, dig into the financials, dig into what it might have going on, figure out what projections, what assumptions we might make, right, to underwrite that deal and figure out, hey, can we get the returns that we want to get on this deal or not? Or maybe we can, but we have to change our assumptions, right? Maybe we need $2 million of rehab because we want to go higher end finishes versus $1 million, right? So that's in a nutshell what it is.
You brought up a good point, right? Like, everybody's box, right? What is a good deal is different, right? So I think before you can even underwrite a deal, you have to determine what is your box, right? What are you and your investors willing to say, that's a good deal, that's something that I want to pursue, right? Once you know that box, it's going to make it easier for you to quickly weed out good and bad deals very, very quickly, right? So that's kind of what it is. You're trying to determine, is this deal good or is this bad, right? And if it's good, how good is it, right?
Yeah, so that's really it. So we're going to go through maybe some things that we look at underwriting. How do you quickly underwrite? What assumptions do we make, et cetera, right? Yep. So, but really, maybe the first step of underwriting, then, what are the most common things you need to know up front?
Up front, you have to have the numbers, right? You can't just go in there blindly making assumptions about every little salient point, right? You need to have something from the seller of the property that's going to give you some kind of guidelines as to how they're operating it currently and how they'd operated in the past, right? Now, on smaller deals, even on bigger deals, we've seen stuff that's been handwritten. We've seen stuff that's, doesn't look official, right? So that makes your underwriting a little bit more challenging, right? But you need financials. You need past financials. If you can get a current rent roll, that's even better, right? Because then you kind of get an understanding of where they're at on occupancy and rents, right? And then you can kind of start building out your model from there. So that's kind of what you need to kind of get started.
Yeah, I mean, you're trying to analyze what is the deal been doing so far, right? And then, including what expenses have been doing and what assumptions can we make it to improve those expenses, for example, right? Including what rents have they been getting and what can we do to maybe get better rents, right? Or maybe it's an operational play. And so all of that is being factored into the model. There's a lot of different models out there. So for those of you looking for one, I mean, feel free to reach out to us. We're happy to share the ones that we've used and which ones we like or maybe don't like. Feel free to reach out to us, guys. But with that said, just to kind of recap for the people that are just now hopping on, right? Money Mondays, we're doing basically live every Monday, going over different topics. Today's topic is underwriting and kind of talking to those. Please submit your questions. We already got some questions from people earlier on, and any questions that we get on our Facebook page, we will go answer it live, right? So maybe to kind of go through a few people, Ronnie says, what's up, gentlemen? Plaid Mondays, of course. We kind of, I guess, manage that up. What's up, David? Mark Chappell says he's having trouble hearing you, Ben. Mark, I think that's probably for the better, but we'll try to get that fixed here.
Can you hear me now? All
But
right. So I'll stop shuffling around. Sometimes my beard gets in the way.
yeah, and so
All right, so you need to know your metrics, man. So what are we, what's the most important things that you're looking at? So say you get the financials from the seller, which is going to be in the trailing 12, right? Which is just the past 12 months and a profit and loss. Maybe you get the rent roll, right?
Yeah.
What are you looking for? What are you extrapolating from that to put into these
so no, I'll tell you. So for me, this kind of goes to, I know this is one of the questions that we got, but really kind of how do you quickly analyze, right? Yep. So for me, I'm looking at a rent roll to see a couple things. I'm trying to see, is this deal already occupied and stabilized, right? So stabilized, for those of you that don't know, 90% occupancy or more the past 3 months. Yep. So I'm trying to see, is this deal already stabilized, and therefore it's not a big lease up. I don't have to account for that type of situation. And really, I'm looking, me personally, my very first thing I look at on the rent roll is seeing, outside of looking at the occupancy, I want to see what is the total build out, right? And then compare that to what they're collecting to figure out kind of that spread, right? The loss to lease. And at the same time, right? If they're hovering at 99% occupancy, that means I could probably push rents. So the very first things I'm looking at is really trying to get a sense of, okay, now this deal, if I'm bills out annually, $2 million, right? Okay, well then you can kind of back in the napkin the expense side too, right? I say, okay, assume 55, 60% is going to go to expenses, so that leaves me 40 to 60%, 40, 50%.
Class C, B minus.
Yeah, with A-class properties, you can probably get away with 45% on the expense side. Again, every market's different. Taxes are different. Atlanta taxes are very different than our Texas taxes, unfortunately. I wish they were more like Atlanta. Texas be more like Atlanta. But really, back of the napkin, a C-class, in Texas, you're kind of looking at 55, 60% expenses, right? And so then I quickly kind of back into that, right? So what does that do to my deal, right? I can quickly get a sense just kind of from really like taking a whiff of the deal, right? Of what that looks like. Another one is very common, I'll think of the residential side, people look at that 1% rule, right? So if you're, with apartments, it's more like a 1.4, 1.5% rule really, right? But what it means is that you're looking for essentially 1% of the unit, the 1% of the purchase price, right, per unit should be at least the lease. And so to kind of drive that home, right, if you're buying a property for $100,000 a unit, right, you better be able to get at least 1% of that, right, annualized. So,
more,
or 1.5 is real. Sorry, I was saying the 1% rule now. With apartments, we're really looking at 1.5. And so very quickly, if someone wants $100,000 a door, I need to make sure my rent on that deal is about $1,300, right? It needs to be there, or I need to be able to get it there, $1,300, $1,400, $1,500. And so kind of looking at those things really quickly just to see what might make sense. And then from that, we start to analyze, right? Really dig into it.
We've been able to just dismiss deals almost like based on two metrics, right? That metric being one, and then where is it located at, right? Like there's just certain, I think the other thing that you have to determine in your box, folks, is not only the returns that you and your investors want, but where do you want to invest in? Right? Do you want to be in Georgia? Do you want to be in Florida?
Do you want to do a C-class lease up, right?
Yeah. Do you want to be in a Class C or do you want to be in a Class B? You need to determine that too, right? Because you can quickly weed through. Because once acquisitions kind of ramp back up, and it's going to happen, it might be another 3 to 6 months, and we might see just a deluge of deals. You're going to have to quickly churn through some deals, and you can't underwrite every single one of them, right? So you're going to have to say, okay, does it hit the 1.25, 1.5 rule, and is it in Texas? If so, boom, I'm looking at it, right? Then you can more do a deep dive with the financials, right? One thing that I also want to kind of point out too is this is not me and Ferris thumb in the air, trying to just wing what we can get in rents and what we can even get on expenses, right? What Ferris said was very, very, very kind of ballpark, right? 55 to 65 is usually where you're at, but it could be a little bit less. It could be a little
trying
bit
to filter out the stuff that is not going to go anywhere.
Yeah, but I just want, my point being here is that you need to work with your property management companies to determine what is likely to be the expenses, what is likely to be the rent in that for that property in that submarket, right? And you should be working with property management companies that are have a whole lot of experience in those markets, right? So they're going to know these types of things,
Yeah.
right? They are the experts. So I don't want you to just assume, oh, I think I can get $1,000 and you're at 800 right now.
Wow.
Why do you think that, right? You know, and even if you said, well, I called around a little bit. Well, I guess that's that's fine, right? But you're probably not doing a deep dive even if when you're calling around, because what you might not know about your comps that you just called is that they're all upgraded. They have all these, you know, these upgrades. That's the reason why they're getting $1,000, right?
Yeah.
Or they all have washer and dryers in the units, and you have a laundromat, right? There, all these things play into the types of rents that you can get on a unit, and so your property management company usually will, the ones that we've worked with, and now obviously we have our own, right? You know, they know these areas so well. They're like, oh yeah, I used to manage at this, and this is the deal with that, and I remember this deal over here. They have literally been in the business for so long that they know what's happening in these little pockets, right? Whereas if you're new to the business, or even if you're experienced, you might not know all these pockets as well as they're going to have been, right?
Yeah, agreed.
So you need to have your team in place too to really flesh out that more deeper dive. You know?
Yeah, and so the question, so what do you do on the debt side, right? So debt is a big piece of it, right? Income is kind of irrelevant without factoring in what the debt does.
Now, you brought up a good point too, right? They want to see your underwriting. So if you're getting into the big boy, big girl game, and you're syndicating these deals and you're buying some bigger properties, they want to see what your pro forma is.
Just for future reference, big leagues.
Big leagues.
More general term.
Okay, big leagues.
But really, the question then really, at what point in time do you loop in your mortgage broker, your kind of what time do you start to get we kind of transition from no quotes to soft quotes to hard quotes, right? What's that timeline like?
You know, obviously we got a good relationship with our mortgage broker, but you know, you have to be cognizant of people's time, right? If you're looking at 100 deals and you know that really you're only going to make an offer on, you know, maybe 5 of those, don't send 100 deals to your guy or gal, your mortgage broker, or even your lender. They're just going to get burned out. They're ultimately going to say, you know, I just don't have time for this person, right? So be aware of people's time, right? We usually would get people involved if we're in a best and final situation, right? We would definitely not sign on the dotted line on a PSA without having a firmed up.
But a lot of that, we're willing to wait it out because we've done enough to be able to ballpark. And so for newer people,
right?
You know, maybe get a term sheet or 2 or 3, right? But you start to get a sense of what it looks like in that market, and then you can try to maybe make some assumptions, right? I know that in certain markets I can maybe get 75 plus LTV with 5 years IO versus other markets we know we can't get more than 1, right? And so you start to figure out the different options there and how that applies
to. It all comes with experience, folks, right? So that's actually a great point, right? So, but you have to, once you kind of have that rule of thumb, then you can start kind of underwriting a little bit more effectively, because then you're going to have more real world numbers to kind of plug in on the debt side, right? Because the operational numbers are one, the debt side of things is something else, right? So we usually would get our mortgage broker involved, usually on a best and final situation or before we get into PSA, right? The other thing that I want to point out too is that the lender, and by default your mortgage broker, they also underwrite the deal too. They might underwrite it a little bit differently, right? So you
have a mortgage broker that knows how that lender is going to underwrite it, so they can position things in the best light, right?
You know, because they might say, you know what, your pro forma is so pie in the sky when it comes to X, Y, or Z, right? There's no way that we're going to sign off on your taxes being at this number, right?
Yeah.
It's going to be this. It's going to be this much higher, and therefore your loan proceeds are going to be this much lower, right?
Yep.
Because the more you have on the expense side, the less that you're obviously going to get on the leverage. So you have to take that into consideration too, that might fundamentally change. Is this a good deal or not?
Yeah.
Right? You know, so they're both very, very important components of underwriting.
What other important? So let's talk about actually escalators, right? So we know with pro forma, the ultimate goal is you're doing a 5, 7, whatever your timeline is, P&L, right? And you're trying to figure out over the life of this deal, what do my returns look like each step of the way, right? And so one of those things that you look at is escalators, right? Meaning, annually we expect rents to increase and expenses to increase, right? And maybe right now with the virus situation, maybe you have to be less aggressive, right? But really, again, as you're modeling it out, and this is where having a sheet that someone else made is already kind of helping you account for all these things. But you need to be aware that, hey, over the life of that deal, the market, the world is changing, right? Hopefully for the better. But just being cognizant of, okay, we know expenses are going to go up because Uncle Sam's always collecting, right? Every year it seems I don't remember the last time my taxes went down on any property, right? Never. So, we have to account for that when all you're modeling. And so again, that's what the escalators are. Usually very, very ballpark, but you're looking at 1.5% to 3% increases both in income and expenses, right? And again, those are very property specific, very location specific, but it's just another metric to think about.
And one caveat for that too, folks, and Ferris kind of touched on this. So COVID is obviously going to water down on rent pops right now. So you just have to be less aggressive on what you're going to underwrite. Right now, with some caveats even to that, right? There might be a clear cut. Everybody in the market is at 1,000, and you're down at 700. So there's obviously, even if you're doing a limited rehab, you can push rents there, right? Because everybody else it's proven out that it's there. But don't just assume that the market is going to carry you anymore, right? For the next year or two, you have to be very, very conservative when it comes to rent increases. But on the flip side, expenses are going up, right? So, just to continue to assume that 1.5% to 3% increases in your expenses is going to continue. That's not going to go down, unfortunately.
Yeah.
Right? You wish that would flatline along with the rent. That doesn't seem to happen, right? And so, that's a great point, right? We have to take that into consideration when you're underwriting, because that's going to skew a deal really to the red or to the green, right? Or to the black, excuse me. It's either a good deal or it's a bad deal.
Yeah.
The other thing that I wanted to point out too that can really play around with the numbers, there's 2 more points, right? Your vacancy, obviously.
We don't need so many points, man. Jeez. No, I'm kidding. People love hearing this. No, I'll keep going.
So, right.
I just wanted to throw Ben off his game a little bit.
Vacancy, right? You play around with that. That can really swing a deal to the good or swing a deal to the bad.
What is economic vacancy for those that don't know?
So you're going to have a combination of a couple different things, right? Everybody knows physical, right? You've got 100 units and 10 of them are vacant, so you've got 90% occupancy, right? So economic is kind of the more economic components of that, right? You've got bad debt and write-off. You've got loss to lease, which is what Ferris kind of talked about. What's the delta between what they want to get and what they're actually getting, right? And then you've got, things like concessions, right? And, do you have to, on that $1,000 a month rent, you have to give them the first $500 off for the first 3 months, right? That's real money that you're not taking in. All of that waters down that gross potential rent that you might get, right? So you have to take that into consideration. So those 2 components are really they can swing a deal, right? The other part of this is going to be your reversion cap rate. You really have to play conservatively now, especially, but even in the past, you didn't want to buy a deal at a 6 cap, right? And then say in 5 years that you're going to sell it at a 5 cap. In my book, and we invest passively too, so we see other people's deals. We've seen deals like that. You know what that is? That's a big red flag to me as being aggressive, right? Because they're saying that cap rates are going to continue to compress for the next 5 years. Nobody knows that. Nobody really knows what's going to happen in 5 years, so it's better to err on the side of being conservative and say that 6 cap is now going to be 6.5 or 7 cap.
And if you do know what's going to happen in the next 5 years, come talk to us.
Yes.
We'd love to see that crystal ball.
Pay a fortune, to come talk to me and show me your crystal ball, right? But ultimately, nobody really has one of those, right? So the rule of thumb is that you have to go in the opposite direction, right? And guess what? If cap rates are at 5 in 5 years, guess what? That's just gravy.
Yeah.
Right?
Don't bet on it, but if you get it,
yeah, you can't
lovely.
go wrong there, though, right? So you better to underpromise and overdeliver than try to overpromise and underdeliver, because a lot of deals can swing way into the good if you have too low of a reversion cap rate.
Yeah.
And so those are some of the things you got to look out for.
So maybe those are some key things to think about with underwriting, right? For those of you that newly tuning in, please drop your questions about underwriting. We have a few we're going to go through, and we will be happy to answer them, right? Ask us, what our assumptions are, or how do we look at things, when do we do things. Ask us about our shirts. We got plaid shirts. They're really nice shirts. We like them. The blue's a good color. I don't know. Ronnie said that was plaid. Ronnie, maybe.
Ronnie, that's it.
Mine is definitely plaid. Ben.
I thought twice because he called me out on it last week, man. So I was like, all right, I'm not going to do the plaid this week.
Yeah. So let's keep going then. So. These are questions that we got online, right? For anyone else that has questions, go ahead and drop them. We'll answer them. So that includes you, Mark and David. I know you guys have plenty of questions. So first question, how do you vet a deal quickly, right? I know I touched on it earlier. You want to go through your kind of, maybe some more of your assumptions, Ben?
I think, Ferris pointed out some really good points, right? You have to know your box.
I got the best answers.
You always do, buddy. You always do. You have to know your box first and foremost, and that's going to vet a lot of deals, right? And then you can do some back of the napkin, right? You can determine, okay, hey, 55% on expenses. This is what the gross potential rent is. You can start kind of backing into a number within 5 minutes to see if it's going to be within range. Now, the rule of thumb, is that if it's within about 90% of the ask, then you should pursue it, right? Now, in some markets that might be 95, in some markets that might be 100, right? It just depends on how competitive it is, right? But if you're within 90% of what the broker is telling you the price is, so give you a round answer, 10 million is what they ask, and you're at 9 million, you should dig in a little bit more and see if you can make that deal work, because more likely than not, you might still be in the running.
Yeah, and still submit an offer, man. You know, the brokers hold their
thing
cards tight. They're trying to obviously get maximum dollar. If you're within 10, even 15%, I would submit.
They're gonna make it.
You lose very little from submitting an offer. If you already done the homework, analyze the deal, you're comfortable with your price, submit.
Yeah.
Sometimes, you know, things happen. Maybe, you know, COVID shows up and the buyer backs out and the seller's desperate to sell. Guess what? It's yours to go win. So.
Absolutely.
Or yours to lose, I guess, depending how you look at it. So
how to determine if a deal is good? We kind of talked about that a little bit, right?
if it's a good property, let us know. We're happy to talk to you about it. We're happy to buy that off of your partner with you. If it's a bad property, you can, you know, share it to other people. But
no,
I mean, yeah, what are the characteristics you look for in a good property, Ben?
It's in the eye of the beholder, right? You know, because there's deals that me and Ferris are like, heck no, we're not going after that. And then somebody buys it because they thought that that was a good deal, right? And then there's deals that we've passed on that, you know, whatever. I mean, they go.
Yeah, to me,
ways,
ultimately,
right?
a good deal. Yeah, it's in the eye of the beholder, but it's a deal that we can line up we can articulate a clear business plan to hit the metrics and numbers that we're looking for. Right? That's in a nutshell what I look for in a deal. So I'm okay with doing a bigger, deeper value add, but I need to be able to put in less assumptions, right? Be able to be more conservative and be able to make more money on that. Versus a nicer, cleaner deal, I'm okay with paying up a little bit, right? But I, you know, again, it's got to be the right tenant base, the right locations, the right market. And so, but really, fundamentally, it's both options. Both can be good deals. They're very different business plans. It needs to be a business plan that aligns with what we're comfortable doing, right? And you know, I don't know if I want to go do a 300-unit deal that's completely vacant off in Topeka, Kansas, as Ben likes to say, right? Versus, you know, other markets.
I'm sorry. Let's use that as
but you know, as an example, right? Some random market, 300 units, completely vacant. That's a lot of work, right? It's not really something that we're set up for. And you know, if I can get it close to free, like would I say no? Probably not. But it needs to make sense, right? I need a pricing discount. Versus if I take that same deal and drop that in Atlanta, I'd be a lot more willing to do that deal, right? So, you know, that's ultimately to me what a good deal is, right? I can put together a business plan that matches what we're capable of and the returns that I need to get for that. And I can see that pathway there. Right, can I pitch it to somebody? It's really maybe one way to look at it.
Ultimately, it has to make sense for your investors too, right? If you're syndicating it, not everybody that follows us syndicates deals, and that's fine, right? Then you ultimately have to have a gut check. Is this enough money for me to pursue this deal, right? But investors, you need to even almost have a bigger hurdle for them, right? Because you know, things do go wrong, right? The market, nobody was talking about COVID 8 months ago. Here we are, right? You know, it's completely changed.
You didn't get the memo?
I didn't get the memo.
You missed out, man.
But you know, the other thing that I want to point out to people, there's still there's a lot of price discovery that's happening in the market right now, right? You know, we're seeing decreased in collections, right? Usually 5 to 10% is what we're seeing from our portfolio and our friends, right? But we're not necessarily seeing a 5 to 10% decrease in the asset prices, right? You know, and I'm not saying.
Nor are we seeing it in the expenses either.
Well, and
more people living at an apartment means more utilities.
Seeing expenses go up, right? Because your utilities are going to go up. There's a lot more wear and tear on the units because people are there more, right? So you're not seeing the one-for-one correlation where you would think, okay, we're going to get at least a little bit of a discount just from that one thing, right? So I would just be very conservative on what you think is a good deal right now because there's still a lot of flux in the market.
Yeah.
So that kind of goes into, you know, the last question.
Before we go to the last question, if anyone new tuning in, right, Money Mondays, 3:30 Central, you know, the goal is really talking about different topics and answering questions live. So if you have questions, go ahead and drop them. We'll answer them right here, right now. And, you know, if we need to stick around later and get another cup of coffee, we'd be happy to do that, right? So, all right, Ben, next question. What are some red flags in the underwriting process?
So, I mean, big gaps in expenses. What we've seen a lot of that I always say is a big red flag. Well, two things, right? Goosing up your gross potential rent. This is where Ferris was saying, I always look at the rent roll, right, and see what are they thinking they can get for the unit versus what is everybody actually paying for the unit. If there's a gigantic delta between that means they're just trying to goose it up for some stupid buyer that thinks that they can actually get that. But in reality, the market says, well, yeah, no wonder nobody's paying for that because nobody can actually get those rents, right? But they're hoping that they can lay that on some sucker that doesn't know any better and thinks that that's the potential of the rents, right? That's big one, a big red flag for me. Another one is gaps in the expenses, right? You'll see things where it's consistently, and then there's 1 month where you don't see any payroll. what the heck happened to the payroll? We know that they didn't let everybody off and then rehire them the next month.
PPP, man. PPP. No.
Okay, well, besides that, right?
COVID, thank you.
That's an outlier. We're not talking about that, right? But in the past, right, if you saw that, you would say, well, what's going on here? And some people, believe it or not everybody's honest, right? You can fudge around with those spreadsheets. You can fudge around with the numbers just to make that NOI number or those expenses look less than they really are, right? So you need to look for inconsistencies in the T12, especially on the expense side, right? Those are going to be some big red flags that I see. You know, lack of transparency on the financials in general is a big red flag for me, right? You know, I love the wholesale line where, you know, submit an offer and then we'll give you financials. We don't play that game anymore. But when I first started off, there was a lot of that crap going on, and unfortunately, that still goes on. I see it in a lot of these Facebook groups. But the seller, if he's really wanting and he or she is really serious about selling, they need to disclose the financials. Yeah. And then they need to disclose the rent roll, right? Because otherwise, how can I make an effective offer that's going to get to closing versus just shooting, you know, a dart into the air in the dark, right? You know, how am I going to actually make something work, right? Because I could be wildly off, right? You know, to the good or to the bad, right? And then we're just wasting everybody's time. So that's a big red flag for me from a buyer or from a seller standpoint.
Absolutely. So let's see, any more questions? If you have questions, please go ahead and drop them right now. We did get one more question. What do you do with assumptions when modeling?
It depends on what it is.
You want to explain what an assumption is, Ben?
So assumption is, you know, once again, you're making an assumption on what's going to happen in the future, right? You know, we talked about our rent escalators. We talked about our expense escalators, right? I think you also make assumptions on what is the physical vacancy going to be and what is the economic vacancy going to be. You know, those are going to be, and then you make assumptions on what your reversion cap is going to be. So some of the metrics that I talked about earlier in the program are some major things that you can make assumptions on. And you can make them very aggressively or you can make them very conservatively. Well, let's start from the economic physical vacancy side, right? And the rent and the expense escalators, right? Work with your property management company, work with your mortgage broker, find out what is, you know, customary in that submarket, right? What has been happening the last 3 to 5 years in, say, Houston, Texas, you know, might not be 100% reality what's going to happen in the next 3 to 5 years, but it's at least going to give you some better idea than just, once again, you're thumbing in the air trying to figure out a number, right?
Yeah.
Same thing goes with the physical and the economic. Same goes with the rent and the expense escalators.
Yep.
And then let's talk about reversion cap. Once again, it needs to be usually 10 to 15 basis points more each year that you own the property, right? Not 10 to 15 basis points less. That's what I was talking about earlier. There's going to be people that will buy it at a 6 cap and say they're going to sell it at a 5. They're being aggressive.
Yeah, absolutely.
There's no way that I would ever underwrite a deal like that because that's the only way they're making the deal work. It needs to be on the other side of things. It needs to be
very true. All right, let's keep going.
Those are my assumptions.
One more last. Well, actually, I interpret the question as like, what is an assumption on the lending side? You know, so basically that's how. So an assumption on the lending side means there's an existing loan that you're stepping into, right? Don't look at that any differently than a term sheet. It's just another term sheet, right? It just happens to be tied to the actual loan on the property. But whenever you're underwriting it, right, you look at it the same. It's got might have some IO, interest only, might not. It has an interest rate. It has a time box, right, that you need to make sure you meet. And, you know, the only thing that might be different is that you can maybe do a supplemental or refi, right? Again, depending on the term. But other than that, I mean, look at it more like it's a term sheet.
Yeah. The assumption is all about the supplemental and how much more you can supplement. Does it make sense to do?
But
you need to work with your mortgage broker to determine, is it possible? How painful is the process? And how much can I actually get in supplemental proceeds? Because most of the time, assumption, just straight in, walking into an assumption, doesn't make a lot of sense because you have to bring a ton more equity to the table.
Yeah, usually your leverage is like 65%, 60%, 50%. I mean, depends on the deal.
And so you're, on a $10 million deal, you might be bringing $5 million to the table, right? Really, on a $10 million deal, how much should you really be taking? 2.5 to 3 million. So you're bringing a lot more equity to the table, and so that's going to water down your return. So work with your mortgage broker on assumptions if that's what the question is about.
All right, and last but not least, so if anyone else has any questions, let us know. But one more simple question. Where'd that question go? It was, do you account for splits in your underwriting? And the answer is yes, because your returns to investors are all tied to the splits. And so be sure you are accounting for that. So if you have a preferred return, make sure you have that modeled in where your investors are going to get that. right? And usually the numbers you're presenting to investors are not the returns of the deal itself, it's the returns that they're going to get. Meaning it's net of all splits, all sponsor compensation, et cetera. So
yeah, we usually look
simple
at the deal,
question, but it's
what's
important.
the pref going to be? What's the split going to be? Usually for us, it's just so everybody kind of knows, but this can change, right? You know, it just depends on the deal. An 8 pref with a 75-25 split, right? And so we underwrite all deals based on those metrics.
Yeah.
And then whatever it spits out the number at the back end, right? If that hits the box that we want to be in, then we pursue the deal, right? We take a deeper dive. So that's kind of...
That's the last question. So if anyone else has any more questions, you know, feel
Make
free
it
to put them in.
interactive.
You know, we're about to wrap it up.
Yeah.
But otherwise, you learned something today, Ben?
I try, man. I learn
I got
something
plenty
new
to
every
teach
day.
you, Ben. It just never
Yeah,
ends. So
I learn something new every day, right? You know, but no, we want it to be interactive, folks. Please submit your questions. We'll get the next topic out in the next day or so.
I don't see any more
Appreciate you
questions
tuning
across the
in.
different things. So if anyone has questions, going once, going twice, going 2.5 times, 2.5 times. All right, well, let's give it a wrap.
All
All
right.
right, well, that's Money Mondays, everyone. Thank you very much. Ferris Musa, Ben Suttles, and we'll see you guys next Monday.